Hey there, Paul.
Hey, what's up, man? Ready to get this going?
Let's do it.
All right, very good. Very good. So let's do this. I'm gonna hit play. I think we're on. I think we're live. Just making sure we give a few seconds for people to sign in. We've got some people coming in, and I think we'll start the conversation going. So hello, everyone. Welcome to AllGen's quarterly updated market review. This is for today's April 22nd, 2021. And we're well into the year now. The year is rocking and rolling. A lot of stuff happening on multiple fronts. So we're excited to be able to come to you, to be able to share our thoughts and our opinions for what it's worth to you, what's going on. At the same time, for those of you who participated in the past, welcome back. And if you have, we are doing something new this time around. We're broadcasting live on Facebook. So you're able to join via Facebook as well. Or if you quickly want to shoot a note to anyone who wants to join us on Facebook without having to go through the whole Zoom registration process, we invite you to extend that invitation to them. So welcome back again. As you guys know, we do this on a quarterly basis to kind of keep you abreast of what we think is going on in the economy with different financial subjects, and also at AllGen in your financial investment life, in your financial planning life, and in your pursuit of financial freedom. So just a quick overview. Again, we're going to be on AllGen on Facebook Live. So if you go to AllGen's Facebook page, you can probably connect there. Okay. At the same time, we've been wanting to keep our people engaged. So part of what we want to do there is we're going to actually open up a poll to get your thoughts and get your feedback and on timely conversations that are happening in the community that we're hearing. So with that said, let's go ahead and bring up our first poll. So what do you think about cryptocurrency? We're hearing a lot about cryptocurrency these days, and we're actually going to address our thoughts on what's going on there. But here's some 4 choices. Pick the one that you think closely approximates your perspective. It's the next big investment opportunity, or it's a huge bubble and it's about to pop. Isn't that the radioactive remains of Superman's home planet Krypton? I know there's a lot of people who thought that would be the case, and I haven't really thought about it before. So please take a second, if you can, click on whichever dial you think represents the biggest or rather closely approximates your thought process. We'll give you a few seconds to do that. All right, now that hopefully you have that, let's go ahead and see what our people are thinking out there. So drum roll please to the person controlling the poll. All right, we've got 38% of folks thinking it's a next big opportunity, 31% thinking it's a bubble about to pop. A quarter of the folks are thinking it's a Superman weakness from the planet Krypton, and then one person saying, I haven't really thought about it before. Okay, great. So we have a divided audience, and that's exactly how we're seeing people out there in the community, even in the professional community. There's division on what to think about this. So one more question before you go away. If we can have the next poll be brought up, please. Drum roll, there you go. Okay, and this is a multiple choice that you can actually answer in more than one way. What does financial freedom mean to you? As you guys know, we're big about spreading this whole message of financial freedom at AllGen, financial freedom for all generations. So choose all that you think apply to you. Financial freedom is retiring so I can spend more time with family and friends. It's having the time to serve and have an impact on the world, or it means having the freedom to choose my vocation regardless of my paycheck. So you can pick more than one answer if you think, oh yeah, I think that, and I agree with that as well. So take a second to do that, please. All right, hopefully that's enough time. So let's see how you guys answered the question. Drum roll for the controller. And we've got, okay, pretty split viewers and listeners. We've got 47% is retiring so I can spend more time with family. It's having time to serve. And then 6% means having the freedom to choose my vocation regardless of paycheck. That's great, because we're all about living on purpose. So we appreciate you sharing that. We do this again so you can be engaged, but also so that you can see the message that we're always bringing to our clients. So without further ado, I'm going to leave you guys with Jason. Here's the agenda for today. He's going to talk about the market review and commentary. We'll have a few quick updates at the end, and then Q&A. As always, we invite you, if you can go to the next slide, please. You have the ability to ask questions. So as questions come up, you can actually hit the Q&A. There's no raising hands here, so we've turned that off. This is being recorded, but no one else sees your questions except us. Okay, so if you come up with a question, I promise we'll try to get to all of them by the end. But please, as they come up and as you say, hey, that triggers this question, please type it into the Q&A box, and we'll at the Q&A session try to get to your question. All right, so without further ado, I'm going to leave you with my business partner, Jason. Jason, what are you seeing? What's going on in the world today?
Yeah, thanks, Paul. So just welcome, everyone. Thanks for joining. Just for recording purposes, today is April 22nd, 2021. So I got a lot of stuff to share, so I'm just going to hop straight in. And obviously, you know, going through a pandemic year, the pandemic is still on everyone's mind, and it has a lot to do with what's going on in the economy. So I start off here with the first slide, looking at confirmed deaths of COVID-19 from a world standpoint. And so as you can see here, the world is still upward trending in terms of number of deaths. A little bit of a drop after kind of the Christmas, New Year's timeframe, but then it started to rise again here recently. So from that standpoint, it looks pretty uncertain, you know, from the standpoint that the world is continuing to increase the number of cases and deaths. But there's some good news here. 944 million doses have been administered. And as a rate of about 16 million doses a day worldwide. So from a world perspective, and that's not every country reporting either, but that's a majority of them. That would be 22 months to reach 75% coverage. So, you know, the way this works in terms of the way I'm going to show the numbers is that a lot of experts say you need 75% coverage of vaccinations to reach herd immunity. Now, that is just looking at it from a vaccination standpoint. I would also make the argument that natural herd immunity is going to play a part in this as well. But when I'm showing you these slides, I'm going to be looking at from a vaccination standpoint where we're at. So the good news is there are a few countries, the United States included, which I'm showing here in the first one, that have really done a good job at vaccinating its people. And so you can see same chart in terms of it's tracking the number of COVID deaths. And you can see we also hit a peak right around that January, you know, after Christmas time, New Year's, but a huge amount of drops. I mean, we went from about 3,400 deaths per day. This is a 7-day rolling average, now down to a little over 700 a day. So, you know, a fourth quarter of what we were at the peak. And while a lot of the world has already started going back up and having more cases and more deaths, the countries that I'm about to show you, which have done a great job of vaccinations, have actually been going down. This is encouraging. Obviously, the less deaths you have, obviously, the better for the world. From an economic standpoint, it's important too, because that's when economies start to open again. When the number of cases go down, when the number of deaths go down, especially deaths, that's when, you know, the flying starts to open up again and traveling restrictions go away and being able to go to restaurants and sporting events and, you know, arts and entertainment and all of that starts to reignite. People drive again. So that's why I focus a little bit of time here in the beginning on COVID, because it's important to watch this. So you can see here, the US had 40% of the population, or there's been 40% of the population that's at least had one dose. And we're vaccinating at a pace of about 3.1 million doses a day. So in 3 months, if we kept up that pace, we would be at 75% coverage. So that'd put us around July timeframe of reaching herd immunity, and potentially even sooner if you count the natural herd immunity with it as well. But I'll touch on that here in a second. A little bit more on that. But this is the UK. So the UK is another country. They actually started a little bit before us. They were first to kind of bring the vaccines to market, and they've done an excellent job of vaccinating. They're at about 50% of the population has had at least one dose. Similar pattern here. You can see how much the number of deaths have dropped. You've gone from literally almost 1,200 to 1,300 a day down to now maybe 35 to 50 a day. So extremely encouraging there. They were a little bit ahead of the United States in the beginning. And also, you know, they're 3 months away to 75% coverage. And the last one here, which has done probably the best job of vaccinating its population, is Israel. And so Israel has about 60% has been given one dose. And you can see at the same time, when it was having a smaller population, obviously, but about 65 deaths a day, they're now down to about 5 deaths a day. So that's super encouraging for the economies in the world as a whole, but especially those that are able to vaccinate quickly. One thing that we are noticing that we're keeping an eye on too is you can see now why is it 11 months for Israel, if you're looking at this, to have 75% coverage. Well, once you get kind of to that 60% mark, not all the population wants to get or is willing to get vaccinated. So you may see a slowdown as we kind of get closer to that 60% mark where not everyone will get vaccinated. I don't personally think you need to have the full 75% vaccinated because I think the natural herd immunity will also play a part of it as well. But encouraging those countries. Now, there's a separate story going on, which is not as encouraging, which is the poorer countries or the countries that have less access to vaccines or have been not done as good of a job as administering the vaccines, have really gone in the wrong direction. So this is India, and you can see the parabolic move in the number of deaths in India. And so only 8.3% have been given one dose, and at 2.6 million doses a day. Remember, their population is over 1 billion. So 24 months until 75% coverage. So that's something to keep an eye on in the emerging markets. And then this is Brazil. Brazil's a little bit ahead of India, but obviously another emerging market. They're at 13% given 1+ dose, doing about 860 doses a day and 11 months to 75% coverage. They were on a similar track to India where they were kind of going to this parabolic move. Is starting to level off a little bit here for Brazil. So something just to keep in mind, there's kind of 2 tracks. There's the wealthier countries that are administering the vaccines really well, and there's the poorer countries that are not administering it as well or don't have access to the vaccines. But we think that is going to get better over time, but it's going to take longer. So, as you kind of look at the economy that we just came from, switching gears here to more economy, you went through obviously a very difficult 2020. GDP worldwide, and we're looking at numbers from the IMF, International Monetary Fund, where last year world output or the GDP was negative 3.5% for the world. That is extremely bad. Obviously, in the United States down 3.4. Even Europe area is down 7. Emerging markets down 2.4. Actually fared better. A lot of that having to do with China not going through it so bad as the rest of the world. And you can see that in the Asian numbers, only down 1.1. But here's the positive thing going forward. We believe there's going to be a huge rebound, especially in the second half this year. You're already starting to see it in the numbers. The PMI, which is the Manufacturing Purchasing Managers Index, and other different manufacturing indexes, and unemployment numbers in general are starting to really move in the right direction, especially here in the United States. And because of that, the economy is starting to rebound significantly. So the projection for this year is a GDP of 5.1 growth in the US, 5.5 from the world, and 6.3 in emerging markets. So that is super encouraging. And then even in 2022, as you see here, continued growth, although a little bit of a slowdown. The United States goes from 5.1 down to 2.5. But you can see emerging markets kind of still stay at that higher rate. They may be hurt a little bit, and I think they are currently because of the coronavirus still lingering in some of those emerging market economies. But they'll still, looks like the economies will still be strong going into 2022. So, as the world went through this pandemic, and looking here specifically at the United States, but it happened in a lot of other countries too, what we're looking at here is the balance sheet for the US. And so basically the total assets of the Federal Reserve. And as this number goes up, and you can see that it's gone up a lot here, especially when the pandemic started, this big move up, that's when you're doing quantitative easing, or the Federal Reserve is doing quantitative easing, which is when they basically create money and then buy bonds with that money. And they've even been taking it to a new level, which they're not only creating money, but they're actually just sending checks to people. So huge amounts of stimulus are coming in the US, a lot of developing nations or developed nations as well, and a lot of countries around the world. But you can see that still continues going forward. We're still creating a lot of money right now. And so, it's been effective at keeping the economy going during this time. There's a chance that we could have gotten into a severe recession, even potentially a depression if that wasn't applied, but there's also potential risk going forward. And one of those things that we're seeing right now, this is a chart of the US dollar, and this is a long-term chart, so this goes back 20 years. So we got to focus in on this last little part here, but you can see from 2011 up until 2020, the dollar has actually been upward trending. It's been strengthening. But as we applied all of that stimulus and created all that money, that acts as a dilution to the currency. And so you can see the dollar has started getting weaker here in the last year, and it's broken this upward trend line, starting to trend down. Recently, the dollar did rally, but then it came up against that 50-day moving average and looks to continue to go lower. So what does a lower dollar mean, a weaker dollar mean? And we have to kind of think about that, and also think about it from the standpoint of what investments should do better if the dollar is going to continue to weaken. So one thing that we think should do well and that we're currently invested in is commodities. And so the chart we're looking at here is the S&P 500 divided by or compared to the commodities index, which is called the CRB. It's the main kind of commodities index which tracks a basket of commodities. And so as the line's going up, that's where the S&P 500 is outperforming. But when the line is going down, that's when commodities are outperforming. So you can see really from about 1999, 2000, all the way to 2011, commodities really outperformed during that time. But really from 2011 going forward, the S&P 500 has far outperformed commodities. But recently, that trend line broke. It hasn't fully broken, but it did break for a little bit, and it's right there at that kind of support trend line. So this could possibly be a trend change where commodities start outperforming again over the long run, and that would play into a weaker dollar scenario. So, we have put a portion of the portfolio in a basket of commodities, also in gold and silver and some of the other metals as well. So that's something that we see going on that should do better in a weaker dollar. The other thing that we've owned for a couple years now is gold. And so this is a long-term chart of gold. You can see it really did well up until 2011, then had this kind of bear market in gold, and then it's built a base, and over the last couple of years has been going up. And if you see here, in the last 2 years, we actually started buying this in 2019, but gold has done really well for us during that time, and it's made a nice run since we initially bought it. Now, if we just kind of zoom in a little bit over the last year, specifically, sorry guys, computers. Okay, we're still on, Paul? Paul, you still there?
Yep, I'm here.
Okay.
Go ahead. You're not presenting anymore. There you go.
Yeah, let me, I'm not sure what happened there. Can you see my screen again now?
I can. You're not in full screen mode, but yeah.
Yeah, I'm getting there. Okay.
Okay.
So sorry about that, guys. I'm not exactly sure what happened there. But as I was saying, looking fast, zooming in on gold over the last quarter, especially, gold's gone down quite a bit. So that, as we have a percentage of that in our portfolio, that has hurt us a little bit in the first quarter. And you can see, even though when we first started buying it back in 2019, over this time period, gold performed really well. Well, gold, out of all the commodities, is considered more of a safe haven. So, the vaccine started coming out in late December, and it's really started getting applied, and people started getting vaccinated quite a bit. Economy started rebounding. So a safe haven asset would typically go down as money would move out of safe havens back into more risky assets. And that's what happened with gold here. You see that it dropped going in this first quarter. Again, that hurt our portfolio a little bit because we have this, but at the same time, we believe this is a good asset to hold in this time frame. And you can see even in April, it started to rebound again. So something that we actually did decrease a little bit of our percentage of gold, but we still think that that's a good thing to hold going forward. Now, switching back over to emerging markets and just kind of looking at the economy for a little bit and how we position money, especially based off of a weaker dollar. Another area that typically outperforms in a weaker dollar environment is emerging markets. At the same time, emerging markets look like they are having a stronger potential growth economically speaking. So we're looking at two different lines, an orange line here, which represents the emerging markets, and the red line here, which represents the US, and this is basically real GDP. And if you look here a little bit further into the future, into kind of 2025 and beyond time frame, they're projecting GDP rates about 4.5% in emerging markets, whereas in the US it's kind of like 1.5 to 2%. So it's nearly a 2.5% difference in growth going forward in emerging markets over the US. So that's one thing. Now the other issue is, if you look at the stability of a country's currency, one way to kind of measure that is not only on economic growth, but it's also how much debt and what's the kind of fiscal strength of their government, how much, and what we're looking at here is debt to GDP. So the amount of debt divided by basically the gross domestic product, or what kind of represents the growth of a country. And the higher this ratio, the more debt you have. The lower this ratio, the lower debt you have compared to GDP and compared to how fast your economy is growing. So you can see the red box here is the United States. These numbers are a little bit old too. So right now it's closer to about 130% debt to GDP, which puts us right at our all-time high where we were coming off of World War II. But if you look in the green here, these are all the emerging market economies. You know, and some of these, like China, for example, at 66%, Mexico, 45%, and look at Russia, 14% debt to GDP. So from that standpoint, emerging markets seem much more stable than like the United States or some of the more developed markets, like even Japan at 266%. So that's also a compelling argument to, potentially putting money into emerging markets. The other side is on the technical side of things. When I say technical, I mean from a charting perspective. This looks at the emerging markets index. And you can see this is the high back in 2007 before the big crash in 2008. But since that time, it's really built a very long-term base. And someone called this in technical analysis kind of a triangle. And you can see it would be bullish using technical analysis if you broke out above these prior highs and at the same time broke out of that triangle pattern. You can see that happened. And so that could have potential from a technical standpoint, that emerging markets can do significantly better going forward and can have a decent run. So switching from emerging markets, now looking at valuations, and specifically valuations in the US stock market. What we're looking here, we're not looking at the stock market, we're looking at two lines here. The blue line is the S&P 500's forward PE ratio. PE being price divided by earnings, pretty standard metric to kind of measure the valuations if companies are expensive, or they're trading at high multiples or expensive, or if they're at good price. And so the highest point we got in history, even if you took this chart back 100 years, this point in the late 90s, during that tech bubble and when internet stocks were doing so well, valuations got up to as high as a forward PE of 26. And then the markets dropped a lot in 2000 through 2002. And then they've gotten recently back up here where valuations hit that same all-time high as he did in the late 90s. Now, the yellow line here looks at basically earnings. And so the PE is made up of two different things, right? It's the price of the stock divided by earnings. So if you go into a pandemic like we did last year and earnings drop, the denominator is lower and the price is higher, that would cause valuations to get more expensive. And that's what happened. With the recession, earnings dropped, stocks became even more expensive. And obviously prices went up. But going forward, there is kind of a silver lining here in that we're expecting, and it's already started happening, where earnings really start to bounce back quite a bit. So the dotted line here is expectations for earnings going forward. And so if you have the denominator, the earnings going up, that would cause the valuations to go down if prices stayed the same. So that could potentially mean that valuations won't be as expensive, assuming prices stayed the same. And that would make stocks not still attractive from the standpoint of being very cheap, because it would still historically be pretty high, but it would make them a lot less overvalued compared to where they were historically. So, or recently. So that's from a valuation perspective. And just in general, with the valuations in the US stock market, we see kind of two different areas There are some bubbles we see out there, specifically in kind of similar to the late 90s, where you see these tech stocks or electronic vehicle stocks, or even some of the green energy stocks, even some of the marijuana stocks. And I'll talk about Bitcoin and some of the cryptocurrencies in a little bit, but there are pockets of like bubble type of areas, especially the COVID stocks. Whatever did really well during COVID, there's some those valuations of those companies are extremely expensive. However, some of the areas that got hit really hard in the coronavirus, like kind of value stocks, industrials, energy, more traditional energy like oil, natural gas, those types of things, financial companies, those companies went down a lot and their prices became a lot cheaper. So the chart we're looking at here is comparing growth stocks versus value stocks. And if this chart went back a little bit further, it only goes back to 2000, but you can see, well, prior to 2000, the late 90s, growth really outperformed. And so when you're looking at this chart, when the line is going down, growth is outperforming. When the line is going up, value stocks are outperforming. And so you can see after the tech bubble popped from 2000 through 2002, value stocks really outperformed and really outperformed for about a 7-year period. But since then, growth stocks have really outperformed, and especially during the pandemic. You see it really dropped off a lot here. Growth stocks really outperformed value stocks. However, we think there's a trend change starting to occur, where you're starting to see now value stocks really outperform growth stocks, and that trend has started to reverse. Where that's happening, value stocks are doing better. And since we are overweighted value stocks now and trying to underweight what we think is in a bubble area, that's helped our portfolio. And so there's still time. Will be able to tell us if that's going to continue to happen and value stocks continue to outperform. But so far over the last year, and especially over the last like 6 months, that's encouraging for value stocks. So shifting from valuations and where we see bubbles and where we see opportunities, looking at it more from a market sentiment point of view. And just so you understand what market sentiment is, that means what is kind of the general view of the population of the market. And the way you read sentiment charts and indicators is that you want to do the opposite of kind of your every average, Joe that does trading. So someone who is just who doesn't really know much about the markets, kind of like as they say in sports, like a weekend warrior. Well, that for investing, but someone who's kind of like, it's a hobby, they're just kind of getting into it. They heard from a friend that, they're making a lot of money, and so they tried it out. Those types of people, and this is not to be condescending, this is just studying how markets work, they tend to be wrong. And especially at extremes. So when those kind of the smaller traders and the, just do-it-yourselfers that are just kind of starting out, don't have really any experience, when they get very bullish, you should be very concerned. And so what this chart is looking at is small trader call buying. Now, call is an option contract. I don't want to get deep into that, but what you need to know is basically if you're buying a call, you're betting on the market go up. And it's one of the riskiest ways, most speculative ways to try to take advantage of an upward market. And so if you're a call buyer, you're betting on the market going up. Now, the way you read this blue line is if it goes up above this dashed red line and it gets really high, there's a lot of those kind of average Joe small traders buying very speculatively in the stock market. And when that has happened in the past, like it happened in 2000, it happened in 2007, it happened right before the pandemic actually, and it's definitely happening right now. All these red dots represent when you're reaching that very speculative area. That has been a sign of a market top. Now, I'm not trying to say that I think the market's going to crash, because I don't. But I think there are pockets of the market that are very vulnerable to a big price decline, which is why we're trying to stay away from some of those, kind of more momentum names, those more popular names that people talk about all the time, which are extremely expensive right now. Because when your average Joe is buying that, they're probably getting in towards the high and about that stock or that market's going to take a hit. So not looking great from a sentiment standpoint. Now, the other thing is shifting gears into bonds. Bonds I've had a few people tell me, and a few of our clients even, why would you even hold bonds right now? Why does anyone hold bonds? The interest rates are near all-time lows. There's no way for them to go but down. And so what we're looking at here is kind of, it is the 10-year treasury yield. And real quick, lesson on bonds. Bonds have two components, the price and the interest rate, and it's inversely related. So as prices go down, as the interest rate goes down, prices go up. Okay, and so this is looking at a chart of the 10-year treasury yield for 40 years, and 40-year yields have gone down, which means if you've held bonds over the last 40 years, they've done really well. Okay, and bond prices have gone up. Now, during the pandemic, when we lowered interest rates down to zero, interest rates got as low as 0.54%. The 10-year treasury bond got as low as 0.54%. But since then, it's almost tripled. The yield has, and gone up to about 1.6%. And so it's already rebounded a lot, which means prices of bonds have gone down quite a bit. So I say that because, there is a chance in the future that yields continue to go down. And I want to make the parallel between where we're at in the United States right now and potentially what Japan has gone through. So now we're looking at the Japanese 10-year government bond, and just so you know, kind of their interest rates, they had a huge economic boom in the 80s, and then have kind of been struggling really since the 90s and beyond, and battling with deflation during that time. They lowered interest rates all the way down, and interest rates went all the way down to about 0.5%. Okay, kind of where I was showing you on that last page, that's where they were back in the early 2000s. It did rebound, and it got up to about 1.5%, and at its very highest point got up to about 1.8%. But you can see since that time, for another 15 years, interest rates have continued to go down, where they eventually became negative. So there is a chance over time that interest rates can continue to go down. And when you have as much debt as like a Japan or as a United States, and I'm not going to get into this because it gets really technical, but it's hard for interest rates to go up. And the government probably won't allow that because it starts to affect a lot of things negatively. So I say all that because I want you guys to think that there is still a good chance that bonds could do well going forward. I'm not saying that's for sure going to happen, but there is a chance that could happen. So going to get super technical just for 1 minute. I'm just about to wrap this up. But this is long-term treasuries, the most interest rate sensitive of all bonds, okay, long-term bonds. And so this is looking at the price of the actual bond itself, not the yield. Remember, it trades inversely. So bond prices would have gone up over that last 15 years versus gone down in yield during that same time. Well, every time this blue line is marked is when it's gone down a lot. And according to the RSI, which I'm not going to get into that, but basically a momentum indicator that shows that it's oversold. So when these long-term treasuries have become oversold, it's been a very compelling buy every time at this blue line. Well, we're the most oversold we've been in 17 years. So I could make the argument that now is actually a decent time to buy long-term treasuries. We're not doing that right now. We already own some long-term treasuries. We started buying it in 2019, right around March of 2019. And it's worked out really well for us. Long-term treasuries have done really well, especially during the pandemic, where long-term treasuries act as a non-correlated asset. They go up a lot of times when stocks go down, especially in recessions. And that happened. It served its purpose. We started selling some of them up here and buying stocks when stocks were down in March of last year. But then you fast forward, we had a reduced position, and going into the over this last quarter, in the first quarter, it's really gone down a lot. Remember, kind of like gold, a safe haven asset, which this is, will tend to go down as markets go up, especially in this case, as the perception of the economy is going to get stronger. It was happening, and that was happening as the vaccine has come out and people are getting vaccinated. So that hurt us a little bit in the quarter, but we think that there is a chance that can still serve its purpose well, which is to protect us when markets falling. And so we want to still hold some of that. Now, so again, wrapping this up here, from a bond side of things, this is kind of our strategy. We're positioning for 3 different scenarios, and some of them have some overlap. But if on our bond side of our portfolio, we're positioned for rising rates by holding agency bonds which are more Ginnie Mae's and Fannie Mae's. So that would be kind of the safest bond that we hold, and that doesn't fluctuate a lot and typically does better in a rising interest rate environment. And we also hold some short-term corporate bonds, which typically does better in a rising interest rate environment, along with an improving economy. And then to protect us for inflation, we're holding Treasury inflation protected securities, which is linked to inflation, where it's, instead of bonds, which typically do poorly in an inflationary environment, Treasury inflation protected securities, those bonds tend to go up in an inflationary environment. And we have a very small portion in some of our portfolios in Chinese bonds. We've held global bonds in the past, but we hold a small portion in Chinese bonds, not only to protect us from inflation, protect us from a weaker dollar, and frankly, as much as no one wants to really admit it, they're stronger from a balance sheet standpoint. So it's a good reason to hold that, and they pay a higher yield. And then we have a small portion in long-term treasuries to protect us for a market falling. Now, the big question on everyone's mind, and we get a lot of questions, is what do we think about cryptocurrencies? So cryptocurrencies, you can see some of the headlines here, just recently topped a market cap of $2 trillion, which, by the way, that's bigger than Apple as a company now. And so, then you have this craziness over the last couple of weeks of Dogecoin. Some people call it doggy coin. But Elon Musk's meme that sent that Dogecoin up a lot, and some people were making crazy amounts of money on this cryptocurrency that was basically kind of a joke with a picture of a dog on it. It gone up like crazy, and then obviously Bitcoin going up really high and hitting new records recently as Coinbase, which is a digital wallet. There was an IPO there. So what are our thoughts on cryptocurrencies? And this is the last slide, I promise. So we can make a case for cryptocurrencies, and we can make a case against it. Basically, cryptocurrencies, especially, well, Bitcoin specifically, the people who are for cryptocurrencies would say it's a scarce resource. And so that's why gold has value, because it's scarce. The opposite of the dollar, for example, where you can just print a ton of it. So, they only have about 21 million over time. There's a limited amount of it. It can't be counterfeit, that's what they say. It's decentralized, so you can't have the Federal Reserve come out and print more of it. It's a hedge against the dollar or other fiat currencies in general. Millennials are really adopting it at a huge rate, and momentum is on its side. There's a lot of people that are buying into it a lot. Ethereum is being used for NFTs. I'm not going to get into that, but basically they use unbreakable contracts to, kind of have digital assets. Like even baseball cards or art and things like that. So, and then increased payment accessibility or acceptability. So that would be the case for it. Now, the case against it is, while Bitcoin is scarce, the number of cryptocurrencies is limitless. You can create as many cryptocurrencies out there as you want. So the scarcity kind of goes away if you think about it from that standpoint. There's a ton of bubble-like characteristics, all right? When people who have really never traded before in their life are all of a sudden buy Dogecoin in up 1,000%, and then other people get on because they heard that story, and they're just buying it because Elon Musk mentioned it in a tweet. That's euphoria, and euphoria tends to go along with a bubble-like kind of characteristics. However, with the stock market and with any type of bubbles can get bigger. So there is that certainly can happen. And governments are starting to ban them. That would be the case against it. So China, India, Turkey, Denmark, a few other countries ban the use of it. Not a lot of people know this, but back in 1933, FDR banned and made it illegal to own gold. And so, and that was the case for 40 years till around in the 70s. So, the government can ban cryptocurrencies. There is the possibility, I should say, that could happen. They're extremely volatile. They go up and down like crazy. Criminals use it. There is a portion of criminal usage of it and money laundering. The people for cryptocurrencies will say, yeah, that happens with cash too. But it's a little easier to do with cryptocurrencies, and you can transfer money across the world in the blink of an eye. So, and the other argument is it decreases the value of the dollar, kind of going back to why governments may start to ban them eventually. But if you pull money out of your currency and go into those cryptocurrencies, that weakens the country's currency. It's not regulated, obviously. So those are all cases against it. The bottom line is, in our investment philosophy, is we prefer low risk, high reward investments as opposed to high risk, high reward investments. And so, if we were to buy, and we are considering buying a very, very small portion of cryptocurrencies, we prefer to do it on a pullback, and we'd also do a very small percentage. We are considering it. However, it's very volatile, and we think that there are some of them are in big time bubbles, so we may hold off on it or never even invest in them. So, but all to say is we are open to it. So I went a little over, and I apologize, but that is that's what I have to say about the market.
Just a few things, right?
Yeah.
Thanks for sharing that. I laughed because Jason says I went a little over. I'm like, that's a common theme here at the office. Jason always going a little over, but that's okay. He's just over. But hopefully that's helpful. I know, someone was texting me. I said, yeah, he's a little nerdy, but he actually means well. And hopefully some good information for you. At the same time, I wanted to share and remind you that there's some questions coming in. Please feel free to ask more questions. We're going to have a Q&A right after this. But Jason, I think you went away from the slideshow. I just want to quickly show people on the planning side. There's been a lot, and these updates are great, and they talk about the market and we're moving. But we want to understand that our big focus at AllGen, that's huge, but we also are big believers in financial planning. And financial planning is not just picking the right stock or making sure your portfolio is right. That's critical, okay, as far as making sure your portfolio is aligned with your goals and your situation. But this whole thing about stock picking, it's interesting. I saw a breakdown where Warren Buffett last year said the average person should not be stock picking. He himself, Warren Buffett does this for a living. He says, I pick wrong quite often, and more often than not. So, and he can afford to. Most of us cannot. And someone broke it down saying, because I got a call the other day saying, hey, I've got $10,000 and I want to invest it. What should I do? I was like, oh, I don't know. This is a person who has never invested in the market, but is, feeling the euphoria, as Jason mentioned, of everybody's making money in the market. And he saw something that for just a couple of hours a day, you too can pick like an expert, and we did the math. And if you have $10,000 and for some reason, okay, you make 50% on your $10,000 in a year, that's amazing. Right? 50% is phenomenal. But at a couple of hours a day, that's about 10 hours a week, so about 500 hours a year, that comes out to $10 an hour. For no guarantee. You can get a job paying more than that in a lot of cases. So it doesn't make sense in most people's mathematical calculation to be picking stocks on your own. Okay, the risk is just too high. And not to mention, stock picking is not the wherewithal, the end all of financial success. Again, are you minimizing tax impact on your portfolio? Are you protecting yourself from risk? There's just so many factors, and this is financial planning. So this is why we've had a big drive this year towards having all our people do some good financial planning, because it goes beyond just one piece. And again, I'm not minimizing. I mean, we have a whole department dedicated to investing. Okay, but I'm saying investing is one piece of holistic financial success. Okay, so we, as a result of that, we created something called a financial freedom score. Many of you already know what yours is, but if you don't, we welcome you to call us or email us and say, hey, we can run you this quick analysis and give you your financial freedom score, something we created ourselves internally. And it kind of shows you where you are. It's a financial health checkup, if you will, taking into account not just where you are as far as money, but your perception of money and your stress related to money and your goals as a result that life leads you to want to pursue. So please call us if you don't have your financial freedom score assessed by us yet. And we love to do that, because at the end of the day, as we asked at the beginning of this presentation, what does financial freedom mean to you? And we emphasize that it means so many things to different people, and that's okay. So part of what we think is critical for you moving forward in life is, are you really optimizing your life based on your finances, based on family, based on what wires you to feel passionate and exhilaration on a day-to-day basis? So that being said, we invite you to either do a financial plan with us or update yours if you haven't already, because we believe this is what really drives and gives meaning to life, and that finances are a piece of that, but are not the, interestingly enough, a financial firm is telling you that money isn't everything. But we believe money is a means to really feeling fulfillment in life. So that being the case, thank you for listening. We want to answer some of your questions. So I'm going to start reading some questions off to you, Jason, if you want to stop sharing this so they can just kind of see me and you.
You want to just
But
remind them real quick how to
Yep, please continue to send some questions in the Q&A, and we'll try to get them. Oh, we have a salutation from Angie Peretti. Hi, Angie. Thanks for listening and being online. We have Rochelle. She said, to your knowledge, have the number of people removed permanently by either death or by severe health consequences of the pandemic been factored into projections of GDP, recovery, etc., in terms of both the available workforce and the available consumer base? That's an interesting question. Jason, any thoughts on that?
Yeah, sure. Good question. And I hope when I talk about this, it doesn't sound compassionate. I feel bad for all the families that have dealt with, losing a loved one. And so, but, the total number of deaths worldwide, from coronavirus has not had a major effect, nor do I think it will have a major effect on the economy. It's just such a small percentage of the 7+ trillion, I think 8 trillion now, world population. And again, just looking at from a number standpoint, the majority of the deaths have come from those that are, a lot of them already retired and not in the workforce. So I don't believe that alone will have a big factor on the economy.
Okay, very good. That's a great question. Okay, and then we have Patricia who, oh, it's Patty. Hey, Patty, thank you for listening. She says, how about all the money that was printed in the past 20 months, the stimulus money and the deficit? Seems to me that there's a bubble that might burst in the economy as a whole. Even the real estate market seems to be overvalued. Okay, so this is going directly to what you're saying as far as we're expecting expansion, but is there any tension pulling that back here? What do you think, Jason?
Yeah, great question. And I touched on one of the slides that showed you the huge, increase of money printing or quantitative easing, and then how many, followed with that were trillions and trillions of dollars of actual stimulus, and which has caused our debt to get up to 130% debt to GDP, and just some people prefer numbers, which is approaching $30 trillion in debt. But you always have to compare that to what is the economy growing at. So that's that debt to GDP factor. So we're at 130% debt to GDP. Usually when you're over kind of 90 to 110% debt to GDP, once you get beyond that, you can still grow as a country, but your growth is usually limited on the upside. And there's certain charts that I've seen, statistics that I've seen that, countries that are over kind of 105% debt to GDP, their GDP going forward is usually less than 2%. So it's a really slow growth, but you can still have growth, and that's a real GDP and factoring in inflation as well. You can still have growth, but it's much slower. And so, but to the point of an asset bubble, whether it be in stocks or whether it be in Bitcoin or whether it be in real estate, at some point, let's take the real estate example, houses become unaffordable for the majority of people. And builders will try to take advantage and build a bunch of houses and sell them. So supply will start to increase. So there's a point at which the price either becomes too high and or the supply starts to increase, where we will reach a high point. And I'm not sure if we're at that point yet. I think we're definitely closer than we were a couple of years ago. We may still have a little bit of room to go on the upside, but it's certainly getting to the point where it reminds me a little bit of kind of the 2005 to 2007 area in real estate, where you're having people, make multiple bids. There's multiple bids on every house that goes for sale. A lot of them are over market value. I heard from a friend the other day that a house going for $80,000 over the asking price. And even, just buying the house without the appraisal, or not, without it even being able to appraise at the amount. So that certainly is bubble-like. Also, we're in Orlando, Florida. A lot of people from around the U.S. are coming down to Florida, which is increasing the demand of houses in Florida. It may not be that way around the rest of the United States too. But all that to say is, I think the prices have definitely heated up, and I don't think you'll see that continued growth rate in real estate or the economy, for that matter, going forward.
Very good. Okay, very good. Henry, you asked a question. I guess you did touch upon this, Jason, but again, he's saying, what is our opinion on investing in Bitcoin and specifically using 401k money to fund it due to the massive amount of money being printed and the expectation of an increase in inflation?
Yeah, so Bitcoin or cryptocurrencies in general, it tend to be a hedge against a falling dollar. So if you're printing money, that could cause, and it has caused recently, the dollar to get weaker. But similar to kind of the real estate analogy, there's a point at which the prices become too high, and a lot of the money that was going to go into it is already in it. And so when you're already in that investment, there's less left to potentially buy and more left to potentially sell. Plus, there's just so much euphoria around that. I think there is some bubble-like tendencies. But like I said before, bubbles can get bigger, and this one certainly I could make the case that that cryptocurrency bubble could get much bigger. The only thing I would say, it kind of as a differentiating cryptocurrencies versus gold, is I definitely wouldn't consider a cryptocurrency a safe haven asset. It is extremely volatile. And so where gold could hold up if the market took a big hit, but in the pandemic last year, when the big drop happened, some of those cryptocurrencies fell anywhere from 50% plus, like Bitcoin, to 90% plus. So that isn't for the faint of heart. If you were to invest in it, I mean, I probably wouldn't do any more than 2% of your portfolio.
Very good. Very good question. And, it's interesting because and I'm going to reaffirm our investment philosophy, which is, we are trying to minimize the volatility or the downside potential for long-term gain. Okay. And the other day, and I don't know if I have to pay for rights for this, Mr. Wonderful, from Shark Tank, made a differentiation between gambling versus investing. He says a lot of people who are entering this market, they're really behaving as gamblers. They're saying, oh, trying to get the big win and trying it without really any substance behind it, where, we're not trying to ride up and down volatility. We're trying to build wealth over the long term. And usually that's done better with the minimization of volatility in your portfolio. So that's going to be a big difference in our approach and most investors' approach, because an investor is trying to almost increase the possibilities of long-term gain, whereas a gambler says they're trying to get quick short-term fixes, and that can go with a lot of potential losses, as we know. Another question that came out here, it says, this for one of our listeners on Facebook, says, thoughts on Tesla or NIO? That's good. I know you have some on that.
So that is one that even in our last market commentary that we thought was in a bubble, both Tesla and NIO. And they have since fallen pretty significantly, 30–40% from its top. So, do I think the technology is cool, and do I think that it can do well over the long run in terms of the technology and the growth of electronic vehicles? Absolutely. I mean, that does appear to be the direction we're going in the future. But you have to separate kind of the concept of what you think is going to work out over the long run, and think about that along with what is the price at which it's trading at. And when I say price too, or when people like me talk about price, they're not talking about, oh, it's trading at $1,000 a share. They're talking about what is its price compared to its earnings, or compared to its book value, or compared to its cash flow. It's a valuation metric. So if we say the price is high, it doesn't necessarily mean that just the stock price is high. It means it's expensive compared to how much earnings or revenue it brought on. Just a quick example, and this is kind of where I think the NIO and the Tesla is, and kind of, if you look back in 1999, kind of going into 2000, Amazon, was at about $100 a share. And was it a phenomenal concept? Absolutely. And you can see the company turned out to be a huge success and still is. But it went from $100 a share in kind of that bubble-like environment, similar to kind of what we're at today, all the way down to $5 a share in 2002. So it lost 95% of its stock price. Did the company work out well over the long run? Absolutely. But who can stick with an investment when it drops 90–95%? Very few people stick with that. If you would have stuck with it and you would have just not looked at a statement or turned on your computer for 20 years, you've done great. But most people can't do that. And so I think the concepts are great. I think Tesla, especially has an unbelievable concept, NIO, similar in China. And I think they'll probably do well over the long run, but at these prices, you're taking a huge risk to buy into it right here.
Fair. That's fair. And again, a lot of this is about making sure your money is doing what you need it to do for you. And that's going to vary depending on where you are on your path to financial freedom. Okay, so I know we're approaching here an hour, so I'm going to wrap this up. I do want to say, Vincent, thank you for listening. I think it's your first time you're listening to us. This will be available. If you go to our Facebook page, the recording will be on there, so you'll be able to see it there. And I believe we send it to all our Zoom listeners afterwards as well as a recorded copy. So you will have access to this. So I'm going to wrap this up. I think we've talked a lot about, cryptocurrency, about what's going on in the economy, still, the pandemic, and I'm going to obviously plug in for my department as far as financial planning. While making money is great, is making money work for you in your circumstance in life is better. So I'm going to encourage you to call us if you haven't done your financial plan, and if you have, we're happy to update that and see where you're at as far as your path to financial freedom and your financial freedom score. So thank you guys so much for listening, and we hope to see you guys soon. Take care now. Have a wonderful day.
Take care.